8 weeks. That's exactly how long the S&P 500 has been on this relentless winning streak. But with inflation risks looming right over us and a hawkish Federal Reserve threatening to step in, is the market just completely ignoring reality? Hello everyone, welcome back to AI Market News. Today's explainer is called The Bull Market That Won't Quit. It's the S&P 500's 8-week streak versus a Fed that may hike. Who blinks first? We're analyzing a massive macro tug-of-war here. On one side, we've got surging U.S. equities defying gravity. On the other, severe geopolitical tensions threatening to spike inflation, based on available data. Let's explore exactly what this means for all of us, especially as we monitor our domestic Japanese portfolios.
Let's begin with Section 1, the market's tug-of-war. The tension we're seeing right now actually stems directly from the U.S. Central Bank. Minutes from the late April FOMC meeting revealed a surprising shift toward raising interest rates. And while the primary driver of this sudden inflation fear, it's energy. As you can see in the chart, crude oil has experienced a massive 50% surge way above its pre-war levels. WTI crude is currently sitting right around $96 a barrel.
For those newer to market mechanics, here's why this matters to all of us. When geopolitical conflicts limit supply, oil prices naturally spike. And those higher energy costs bleed into everything we buy, driving up the overall Consumer Price Index, or CPI. To combat that rising inflation, the Federal Reserve is forced to consider hiking interest rates. Basically, by making borrowing more expensive, they're intentionally trying to cool down the entire economy.
Moving on to Section 2, equities defying the odds.
So, with energy prices soaring and the very real risk of a hawkish Fed hanging over us, we really have to ask, why on earth is the stock market continuing to rally so aggressively? Well, the graph shows the S&P 500 index posting an absolutely incredible 8-week green streak. This is literally its longest uninterrupted winning streak since December 2023, bringing the index up 9.17% year-to-date. According to current market information, there are 3 main engines powering this defiance. First off, corporate earnings are remarkably strong right now, tracking 13% year-over-year growth. Second, market breadth is expanding. It isn't just a handful of tech giants carrying the load anymore, as seen by the Dow hitting new highs. And finally, a massive $725 billion AI infrastructure spending cycle is injecting real, tangible capital into the broader economy. These underlying business strengths are just completely overpowering those immediate fears of inflation.
Now let's turn to Section 3, currency and the Japanese market.
We really need to look at what this turbulent macro environment means for all of us as Japanese investors managing our domestic portfolios. Just recently, we saw the Tokyo market drop off by about 260 points, which was largely driven by profit-taking. But right alongside our domestic equities, we absolutely must pay very close attention to the highly volatile USD/JPY exchange rate, which has been hovering near 159.
Let's break down the yield spread mechanism here. When a hawkish Takawa U.S. Fed considers raising interest rates, it drives up American bond yields, and global investors naturally move their money toward those higher returns. This massive capital outflow strengthens the U.S. dollar and severely weakens the yen. In turn, this dynamic puts serious downward pressure on the Nikkei because capital is physically leaving Japan to chase those higher, safer American yields.
Next up is Section 4, the AI IPO wave.
Beyond the whole inflation debate, there's a massive catalyst looming on the horizon that's set to define the second half of 2026 for all of us as retail equity investors. $135 billion. According to current market information, that's the estimated combined incoming equity supply we expect from the highly anticipated SpaceX/xAI and OpenAI IPOs.
The mechanism here is rooted in simple supply and demand. This influx of $135 billion in new stock represents an unprecedented amount of equity supply hitting the market. To buy into these massive new AI giants, institutional investors are going to be forced to raise cash. They'll do this by selling off their existing technology stocks, triggering a major portfolio rotation across the entire sector and completely re-rating current valuation benchmarks.
Finally, let's look at Section 5, key indicators to watch. To see who blinks first in this standoff between the market and the Fed, we need to consult the economic calendar. Keep in mind, all times shown here are in Japan Standard Time, or JST. Tonight, Tuesday at 2300, we have CB Consumer Confidence.
But the real main event is Thursday night at 21:30 JST, featuring revised Q1 GDP and the absolutely crucial April core PCE. Here's the key mechanism at play. If that core PCE number comes in hot, meaning anything above 3.3%, the markets hope that piece will bring rate cuts instantly breaks down. If that happens, we should expect sharp, immediate reactions in bond yields, the dollar, and global equities.
So we're really left walking the tightrope here. Will a Middle East ceasefire effectively unwind the inflation trade, or will a data-driven Fed ultimately step in and break this historic stock rally? Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.